Jai Hind everyone. Welcome to my YouTube channel which is Explore Yourselves, Banking and General Knowledge, etc. Today I will discuss some potential overseas posting examination questions and the corresponding sample answers for bankers. Today marks part 13 of my Path to the Corner Office series for posting examination questions and the corresponding sample answers for bankers. When a bank purchases an export bill drawn on a D&A documents against acceptance basis, the purchase is effectively treated as option A, a secured advance against the merchandise, since the bank retains the bill of lading until maturity. B, a clean advance, since the bank security is the only signed undertaking of the drawer and acceptor. C, a contingent liability, since the drawer merely acknowledges receipt of goods. D, a documentary advance, since the insurance policy remains with the bank as collateral. The answer is option B, a clean advance, since the bank security is only the signed undertaking of the drawer and as accepted. Status reports on drawers and drawings of foreign export bills must be revised at least option A once every 2 years unless there is a specific adverse development, option B once in 6 months or more frequently if outstanding balances are high, C once a year at minimum and must be kept up to date, D at the time of individual bill purchase regardless of previous reports. The answer is option C once a year at minimum and must be kept up to date. Under FEMA 1999, the normal transit period (NTP) fixed by FETEI is used to calculate the notional due date, which for which category of bills is NTP not applicable? Option A, side bills drawn payable on demand. B, usance bills drawn payable 60 days after bill of lading. C, bills after due dates are reckoned from the date of shipment or bill of exchange. D, bills drawn under irrevocable letters of credit confirmed by the advising bank. The answer is option C, bills where due dates are reckoned from the date of shipment or bill of exchange. A bill is expressed in a foreign country and drawn on a site DNP basis. The rate used to calculate the rupee equivalent of the time of at the time of purchase should be option A, the TT buying rate prevailing on the day of purchase. B, the bill buying rate ruling on the day of purchase or the contracted rate if under a foreign forward contract. C, the TT selling rate since the bank is acquiring a foreign currency asset. D, the usance bill buying obtained rate obtained from the treasury branch. The answer is option B, the bill buying rate ruling on the day of purchase or the contracted rate if under a forward contract. House bills are explicitly excluded from ECGC guarantee covered under WTPSG because option A, house bills are drawn to affiliates or associates, making them effectively one signature instruments, not genuinely two name bills. B, house bills are always drawn on a DA basis, which makes them ineligible for post shipment guarantees. C, house bills are typically for small value and do not meet the ECGC minimum threshold for paper. D, house bills are drawn on domestic buyers through an overseas intermediary, creating transfer risk. The answer is option A. House bills are drawn on affiliates or associates, making them effectively one signature instruments or not genuinely two named bills. After an overdue export bill, foreign currency has remained unpaid beyond 30 days of its date. The mandatory action required under FEDAI rule is option A. The bank must recall the advance immediately and report to RBI. B. The bank may at its discretion grant the exporter a further 30-day extension. C. The foreign currency liability must be delinked, crystallized at the TT selling rate ruling on the 30th day. D. The bank must file a report of default with ECGC within 15 days of the 30th day. The answer is option C. The foreign currency liability must be delinked, crystallized at the TT selling rate ruling on the 30th day. When an export bill that was previously crystallized into rupee liability is subsequently realized, the Authority dealer applies. Option A, the TT selling rate prevailing on the date of realization. B, the original bill buying rate at which the bill was first purchased. C, the TT buying rate of exchange or the contracted rate if a forward contract was booked after crystallization. D, the FEDAI official rate published on the date the proceeds credit the nostro account. The answer is option C, the TT buying rate of exchange or the contracted rate if a forward contract was booked after crystallization. The next question is the maximum period for which AD Category 1 banks can extend their own authority at one time. The period for realization of export proceeds beyond 9 months from the date of export is option A, 3 months at a time with a total cap of 9 additional months. B, 6 months at a time irrespective of the invoice value of the export. C, 12 months at a time subject to RBI approval for each extension. D, 6 months at a time but only for exports with invoice value below USD 1 million. The answer is option B, 6 months at a time, irrespective of the invoice of the export. For an export bill drawn at 60 days after sight, the concessional rate of interest on the post-shipment credit is applicable for a total period of option A, 60 days only the use-in period, B, 25 days only the normal transit period, D, C, 85 days only 60 days use-in plus 25 days NTP, D, 90 days 60 days use-in plus 30 days grace period. The answer is option C, 85 days, 60 days use-in plus 25 days NTP. Under the ECGC hold turnover post shipment guarantee ECI BWTPS, the percentage of cover available when the exporter is a policy holder is option A 75%, option B 90%, option C 60%, option D 95%. Answer is option D 95%. The discretionary limit DL under the ECGC hold turnover backing credit guarantee scheme WTPCG up to which a bank can grant advances without prior ECGC approval is currently option A rupees 100 lakhs, option B rupees 200 lakhs, option C rupees 300 lakhs, option D rupees 500 lakhs. The answer is option C rupees 300 lakhs. A report of default ROD under the ECGC WTPCG must be submitted to ECGC within A, 1 month from the date on which the advance become overdue. B, 6 months from the due date of the advance, irrespective of whether it was recalled. C, 1 month from the date of calling up of the advance, or within 4 months from the due date or extended due date, whichever is earlier. D, 4 months from the date on which the branch first noticed the default. The answer is option C, 1 month from the date of calling up of the advance, or within 4 months from the due date or extended due date, whichever is earlier. The bank files a claim under ECGC WTPCG. The time limit for filing the claim of the date for submitting the report of default is option A, 3 months extendable by a further 3 months with ECGC approval. B, 6 months from the date of the report of default unless extended in writing by ECGC. C, 4 months from the date on which ECGC acknowledged the report of default. D, 12 months from the date that the advance first became overdue. The answer is option B, 6 months from the date of the report of default unless extended in writing by ECGC. Under UCP 400 Article 14B, the maximum time allowed to a bank for examination of documents presented under a letter of credit is option A, 3 banking days from presentation, option B, 5 banking days from the date of presentation, C, 7 calendar days from presentation, D, 5 calendar days from the date documents are received by the issuing bank. The answer is option B, 5 banking days from the date of presentation. Under UCP 600 Article 27, a bank will only accept a clean transport document which statement correctly defines a clean transport document. Option A, a document that bears the words clean on board explicitly printed or stamped by the carrier. Option B, a document bearing no clause or notation expressing expressly declaring a defective condition of the goods or packaging. C, a document on which all the freight charges have been prepaid and confirmed by the carrier. D, a document that is free from any reference to charter party arrangements. The answer is option B, a document bearing no clause or notation expressly declaring a defective condition of the goods or packaging. Under Article 18B of UCP 600, a bank may accept a commercial invoice in excess of the account permitted by the credit provided. Option A, the beneficiary provides a written explanation for the excess. Option B, the excess does not exceed 10% of the credit amount. C, the bank has not honored or negotiated for an amount in excess of the amount permitted by the credit. D, the issuing bank has specifically authorized acceptance of invoices with slight variations. The answer is option C. The bank has not honored or negotiated for an amount in excess of the amount permitted by the credit. Under UCP 600, if a letter of credit calls for insurance coverage but does not specify the percentage or amount the insurance document must cover, at least option A, 100% of the invoice value, B, 110% of the CIF or CIP value of the goods, option C, 115% of the FOB value of the goods, option D, 100% of the CIF value plus foreign strikes risks. The answer is option B, 110% of the CIF or CIP value of the goods. All authorized dealers in India subscribe to UCP 600. From which date did UCP 600 2007 revision public ICC publication number 600 coming to effect in India? Option A, 1st January 2007, B, 1st April 2007, C, 1st July 2007, D, 1st October 2007. The answer is option C, 31st July 2007. When a full text letter of credit is established by authenticated SWIFT MT 700, which of the following is correct under UCP 600 Article 11? Option A, the original mail confirmation that follows is the operative credit instrument or the SWIFT message. B, the authenticated SWIFT message itself is deemed the operative credit instrument. Any subsequent mail confirmation shall be disregarded. B, both the SWIFT message and the mail confirmation together constitute the operative credit instrument. D, the SWIFT message is only a preliminary advice. The LC becomes operative only after the beneficiary acknowledges receipt. The answer is option B. The authenticated SWIFT message itself is deemed the operative credit instrument. Any subsequent mail confirmation shall be disregarded. Confirmation of a letter of credit may be added up by Bank of India under only under which condition? Option A, whenever the beneficiary requests confirmation regardless of whether the issuing bank has authorized it. B, only where the foreign bank is well known and exposure limit is set and the commitment is within that limit at the request of the issuing bank. B, C, whenever the LC is irrevocable and has been advised through Bank of India without a specific request from the issuing bank. D, when the beneficiary's bank provides a counter guarantee to cover Bank of India's confirmation risk. The answer is option B, only where the foreign bank is well known and exposure limit is set and the commitment is within that limit at the request of the issuing bank. Silent confirmation of a letter of credit refers to option A, confirmation added by the advising bank without informing the issuing bank. B, confirmation added at the request of the beneficiary, not at the request of the issuing bank, which is prohibited under Article 8D of UCP 600. C, confirmation that is implied by the advising bank's act of advising the LC without explicitly stating it in the covering letter. D, a confirmation that is conditional upon the documents being strictly compliant with the LC terms. The answer is option B, confirmation added at the request of the beneficiary, not at the request of the issuing bank, which is prohibited under Article 8D of UCP 600. Under UCP 600, if an LC does not indicate whether it is revocable or irrevocable, the LC is treated as option A, revocable, as the issuing bank must explicitly state irrevocable for the commitment to be binding; B, irrevocable, as all credits issued under UCP 600 are deemed irrevocable without even explicit indication; C, provisional, subject to the issuing bank confirming its commitment within 5 days, 5 banking days; D, void, as an LC must explicitly state its nature to be valid under UCP. The answer is option B, irrevocable, as all credits issued under UCP 600 are deemed irrevocable even without explicit indication. Under the transit clause of institute cargo clauses A, B, and C, the insurance terminates when goods are delivered to the final warehouse or or on the expiry of how many days after completion of discharge the final port, whichever is first. Option A, 30 days; option B, 45 days; option C, 60 days; option D, 90 days. The answer is option C, 60 days. Under the Institute War Clauses cargo, the insurance terminates when cargo is discharged from an overseas vessel at the final port or on the expiry of how many days from midnight of the day of arrival of the vessel at the final port. Option A, 60 days; option B, 30 days; option C, 15 days; option D, 45 days. The answer is option C, 15 days. Thank you very much for your patience. Please like and share this video and subscribe to my YouTube channel.